Good afternoon, everyone, and welcome to the Q4 2021 Stable Capital Fund update. My name is Megan, and I am joined on the market research team by my colleagues David and Douglas. With us today, we have our investment strategy team, which comprises of Snehan, Griff, and Ahmed. Today, we are going to be discussing an overview of the fund and how we compare to our benchmark indices. We will be looking at current affairs such as post-pandemic markets and inflation. We'll use these trends to discuss our repositioning strategy. Our investment team will pitch an asset positioning opportunity, as well as discuss the future of the fund. And now I'll pass it to David to get us started.
Thanks, Megan. To start things off, we'd just like to provide a brief summary of the Stable Capital Fund. We are an evergreen investment vehicle with $3.25 billion in assets under management. It's at about 65% leverage. We're targeting core plus investment opportunities with a potential IRR of 11 to 13%. When benchmarked against the ODCE index for portfolio weights, we're heavily invested in multifamily and a little bit underweight in assets like industrial, office, and specialty sectors. We believe that this kind of weighting presents some strengths and weaknesses, and there are ways to improve performance through some reallocation of assets. Another key consideration of our fund is a potential $200 million investment that could be coming in from a university endowment. This university endowment has expressed some concerns about our office investments, and we believe that the ability to lock down this investment could hinge on the repositioning of a particular office asset, which our investments team will discuss in more detail later on. But for now, I'm going to hand it off to Douglas, who will discuss some current macro trends in the industry.
Thanks, David. So we want to take a step back and examine some of the real estate market and macroeconomic trends that have informed the decision-making of our reallocation strategy and repositioning decision, which our investments team will discuss later on. First, the pandemic impact on real estate. 16 million Americans relocated within the first 6 months of COVID-19, and major Sunbelt cities like Phoenix, Tampa, Miami, and Raleigh punched above their weight in attracting multifamily tenants to this region. Second, in addition to migratory trends and patterns, there was also a change in consumer purchasing behavior. E-commerce sales grew by over 30% in 2020, and this trend is expected to continue in the future as well. Thirdly, the life sciences sector sucked up a huge amount of capital as vaccinations and public health remain at the forefront of global issues. In real estate terms, this translates into life sciences firms taking larger positions of specialty real estate as they continue to grow their operations. Now, we're going to look at more specific real estate subsector impacts of the pandemic. On the left, we have strong outperformers. Moving to the right, we have underperformers. As mentioned, e-commerce and supply chain issues created huge demand for industrial real estate over the last year. Additionally, specialty assets like self-storage experienced record-breaking low vacancy levels and record high year-over-year rent growth rates during the same time period. Moving into the rebounding sector, Class A multifamily and Class A office in urban environments experienced a huge amount of change over COVID. First, with mass exodus of people from urban environments, and second, with mass return, and now with work from home as a status quo for many companies. We believe the story is still unfolding for assets in this class. Finally, on the right side of the screen, we have our lagging assets. Traditional secondary market office and traditional retail make up the core of struggling real estate assets. 15,000 retailers closed over the course of the pandemic, and just today, CVS Pharmacy announced the closure of 900 stores over the next 3 years, and major retailer Macy's today also announced that they will be hiring a consultant to help spin off their e-commerce business from their traditional retail operations. Finally, we would like to look at the impact of the Consumer Price Index on real estate. Inflation trends reveal acute strengths and weaknesses across different real estate asset classes. Industrial and specialty real estate have strong, inflation-resistant, underlying economic fundamentals. For example, US inbound container shipping volumes increased by 15% over September 2021 alone, signaling very strong continued downstream demand for industrial real estate assets. Additionally, multifamily has historically been the darling of high inflation environments, as short-term leases and landlord right of removal allow owners to increase rent at a pace higher than that of inflation. Generally speaking, If inflation stays in line with the 2% Fed target, we believe that our asset positioning on the previous slide reflects our expectations of growth across different real estate sectors. In contrast, in a higher inflation environment, we believe specifically that specialty real estate, multifamily, and short-term WALT triple net industrial real estate represent the core of outperforming assets moving forward. With that, I'll pass it along to our reallocation strategy discussion.
Thanks, Douglas. We've identified some opportunities kind of across property types where we can help increase performance of our portfolio. We'll start with multifamily. And for each of these asset classes, we've identified some key trends with the red dots signifying trends that we believe will weigh heavily on this property type, yellow, moderate, and green trends that we're less concerned about in regards to the property type. With multifamily, the one big trend that we've seen and we're focusing on is this mass migration from primary markets to secondary markets, with tons of people moving from cities like San Francisco and New York City to Sunbelt markets like Atlanta and Austin. Having just flown in from the Northeast, I understand why this trend is continuing. Inflation, as Douglas referenced, is not as much of a concern for multifamily as these leases are kind of constantly renewing and turning over, and we can keep rent increases on pace with inflation to increase performance of the asset. In general, our investment thesis for multifamily is, it's an area we're already very heavily invested, but we want to maintain this significant investment because it's been a strong performing property type. We're thinking about selling potential properties in markets like San Francisco and the Bay Area that have struggled during the pandemic and looking to reinvest in some secondary markets like Denver and Salt Lake City, which we consider to be secondary markets that have performed very well, but haven't seen quite the same amount of competition and cap rate compression as we have in the Sunbelt. Additionally, we may also look to sell in areas like Miami and Southeast Florida, where we might be able to capitalize on kind of historically low cap rates. Moving on to industrial. This is another property type that's performed extremely well during the pandemic. Inflation is a concern here, as referenced before, as longer-term leases might have rent escalations that are outpaced by inflation, and that would hurt property performance. Flight to quality is another thing we considered here with industrial, as new Class A industrial space can be built in a relatively short amount of time. Sometimes as short as about a year. So new Class A space can hit the market very quickly and help attract some of your top tenants away within industrial. In general, our investment thesis on this property type is that it's been performing very well, and there are really strong underlying economic indicators like rent growth, low vacancy, and the boom in e-commerce that have increased demand in industrial, and we believe that this supports increased investment in this property type, particularly in areas like Miami and Savannah and Charleston, some of these major Southeast port cities. And I'll hand it off to Megan, who will discuss our strategy for office space.
Thank you, David. As we look at traditional office, we are reassessing our position in gateway markets. For flight to secondary markets, we see this as a continuing trend with high severity. Sales volume from Q2 has increased, with buyers focusing on suburban assets. 3/4 of office jobs lost during the pandemic have now since recovered. However, the full return to office still remains in flux. This is why we recommend we hold assets in secondary markets such as Austin, Miami, and San Antonio. As we look at inflation, we see the sector being split, with Class A tenant credit qualities being profiting, and Class B and C doing not nearly as well, especially if it is a long-term WALT or full-service tenant. They're being outpaced by inflation. As we look at the flight to quality, we are also seeing significant trends here. Tenants are looking for smaller spaces in Class A assets, and subleases are at an all-time high. However, we have seen that additions have slowed for the past 3 consecutive quarters. And with this, we recommend that we transition our Midwest primary market assets to gateway coastal city Class A assets. We believe with the low prices now and the increase in office usage that we will have stable returns for the future. Now we're going to look at life sciences and specialty assets. For the migration to secondary markets, we see that this is a significant trend for both self-storage and life sciences. Self-storage boasts a low vacancy rate of 7.3% in Q3, and the in-migration to secondary markets is a key demand driver. Life sciences has a high barrier for entry for both occupiers and investors, especially in key markets. So we're seeing an increase in secondary markets. However, there are few of these that can actually boast a robust ecosystem for life science. These include Boston, Raleigh-Durham, and San Diego. Inflation is less of a concern for both of these assets as they're able to keep pace with inflation. However, we see that in life sciences, some of the tenants might be concerned about increased energy prices. We do not believe that this will affect the demand, as demand should increase as capital continues to flow and talent continues to grow. When we look at the flight to quality, this again is also not something we are as concerned about, as both sectors boast low vacancy rates and high demand. Biologics and life sciences are gaining market share against traditional medicine with increase in technology and a consistently aging population. So we believe that we should increase our assets here and continue moving forward. Now I'll pass it on to our investment team to discuss the positioning opportunity.
Great, thank you, Megan. So the opportunity that we have right now, we're calling the Box. It is a 200,000 square foot Class A office building that's 100% leased to an investment-grade tech tenant. The property also has 50,000 square feet of beam-free floor plates and 12.5-foot ceilings per floor. More importantly, the property is very close to public transportation, making it a very desirable location. And it's also received very high marks from contractors and architects in the area for it to be repositioned at some point in the future, which we'll talk about in the next couple of slides. Before we do that, however, let's go through the investment timeline and the current cash flows. Now, the property was acquired originally in 2014 for a price of $100 million at a 6.24 cap rate. 5 years later, in 2019, the property was refinanced at a value of $146 million at a 5% cap rate. We believe that 124 basis points adjustment between those 5 years makes sense for the property, given the cap rate compression that we've seen in that period of time. Currently, we're in Q4 of 2021. The broker's opinion of value for this property is $165 million. However, that puts the property at a 4.76 cap rate. Now, given the volatility in office space for the past 2 years, everything that's happened with the pandemic, and the fact that the current tenant's leases will be done in 2 years, we don't feel like that 4.76% cap rate is very accurate. So what we did was we underwrote to a 5% cap rate, and just to be a little bit conservative, and that puts us at $157 million what we think the asset is worth. This presents a great opportunity for us. I'll pass it on to Griff to talk about what are the different options to utilize the property right now. Thank you.
Thanks, Neha. So in our first scenario, we take that $157 million purchase price, which nets us around $87 million in equity. This allows us around $220 million worth of purchasing power that we plan to invest in a Class A industrial asset that's stabilized and cash flowing in a major market. Okay. As you can see, this results in a 10.9. Previous slide.
Sorry.
This results in a 6% unlevered IRR and a 9% levered IRR. Okay. Go to the podium? Yeah. Okay. This results, as you can see, we also end up with a 7.93% average cash-on-cash return due to the fact that we were buying a stabilized cash-flowing asset. Second option, please. In our second option, we decide to retain the asset. We have 2 years of lease term left on the asset, which we feel comfortable in the fact that we can go out and find a new tenant. After 6 months of downtime, we've underwrote a very conservative rent of $47 triple net, which allows us an unlevered return of 10.9% and a levered return of 14.9%. As you can see, our cash on cash is 1.77 is low, due to about $12 million of releasing costs the year prior to disposition. Next, please. In our third scenario, we partner with an experienced life science operator to completely redevelop the property into a grade A, Class A life science property. Due to the location of the property, we feel this might be the best option forward. After a $20 million renovation budget, we see returns of project level of 18.6% and a cash-on-cash of 9%. After the operator takes their cut, we're looking at around 17% LP level unlevered returns for the asset. Next, I will pass it off to Ahmed, who will walk you through our decision-making process.
Thank you, Griff. So, as always, when investing in any sort of investment decision for the fund, we always look at that first hurdle. Does it meet the fund's stated criteria of an 11 to 13% return? The first option that Griff presented just does not do that, so it's a non-starter. The second option could do that. However, we don't feel very strongly in the fundamentals of office, especially in this location. So in order to hit those returns, we would need our underwriting to hit perfectly, and we're just not comfortable moving forward with that. So therefore, we'd like to recommend the third option of converting the asset into a life sciences center. We believe that not only does this meet the target returns by exceeding them, but also it provides a higher purpose. It's providing a lab space, which is really critical in the market right now, as more money is needed for medical advancements. The three reasons why we really love this conversion concept is due to the low-cost basis that we have for the asset currently, which means that it will be cheaper than building a new life sciences asset. Secondly, it is the partnership with the operator, who has a lot of experience doing these conversions, and they've also provided us with a fixed construction cost, which mitigates the two biggest risks with development deals. Number one, cost overruns and delays. The third reason we love it is because it is located in currently a top 5 market for life sciences, but more so, the specific location is within a premier life sciences cluster. This makes it very attractive to prospective tenants once the conversion is completed. As with any investment opportunity, there are of course some weaknesses and threats that we have to mitigate against. Namely, those weaknesses are that it's a capital-intensive redevelopment. Between the conversion and the leasing costs, we'll probably deploy about $50 million over 2 years, while not receiving any income during that period. Also, by its very nature, life sciences assets are very restrictive in terms of their future use. And looking at the wider threats in the industry, there is a strong supply pipeline for these types of assets that are coming online. And also, speaking to other brokers and other owners of office assets in the area, we know that other people are trying to follow the same strategy of converting their offices once their tenant leases expire. So to mitigate against this, what we've done is we've underwritten to a conservative exit cap of 5%, which is what similar assets are currently trading for in the market. So we're not accounting for any sort of compression there. Furthermore, we've underwritten a very low rent growth of 2.5%, which is way below current market growth rates for rent, as well as inflation. Furthermore, when running a sensitivity analysis, even if we were to come in at an exit cap of 5.5% and with no rent growth over the next couple of years, we'd still be able to beat the returns that any of the other strategies provide. Now I'll pass it back to Sneon to talk about the future of the fund.
Thank you, Ahmed. In looking at the future of the fund, we'd like to boil it down into 3 themes. Reallocate, redevelop, and reimagine. So regarding reallocating the funds, our market research team talked about pulling assets away from the multifamily assets from the Bay Area, reallocating them to the Sun Belt, for example, office in the Midwest, and reallocating them to port cities. Same thing goes for industrial in port cities as well. We want to focus on both markets and areas and sectors that are going to be growing in the future, which is why we think the redevelopment of the box is such a good idea. We feel that it's a premier life science asset, and it fulfills all the boxes of fundamentals within both a location standpoint, a asset standpoint, and a financial standpoint. Location, it's in a sub-market where there's a big cluster of life sciences assets. This property is set to deliver in 2023 if we proceed with it. There's going to be a very low supply pipeline at that point, so those factors are there as well. From a financial standpoint, we talked a little bit about how it's a little bit more inexpensive to redevelop versus to rebuild a brand new property. And then lastly, from an asset perspective, a lot of the tenants in the life science space are looking for that 50,000 or higher beam-free floor plate kind of space, as well as the high ceilings, which this asset would have. And then, for the future, we're looking for whatever the next real estate boom is going to be. We strongly feel the life science sector is heading that way. Sure, it has its risks, but we feel that we've underwritten conservatively and we've mitigated a lot of those risks that we talked about earlier. We're also looking at assets within the digital infrastructure type of asset class. And we really feel like we can continue, if we reinvest in those assets, we can continue delivering the returns that we've been doing over the past couple of years. And with that, we'd like to thank you all for your time. We'll open it up for any questions, and we hope we can proceed with our strategies. Thank you.
Questions? For your IRR calculations, what is your equity contribution at time zero?
For which scenario?
What's your, when you run your IRRs, what's that equity contribution at your initial close of either case, the reinvest in office or the conversion?
Sure. We were looking at $87 million as we reinvest into the asset.
What's that 87 calculated from?
So,
Yes. Go ahead.
so that's off a 60% LTV. We took a conservative approach to leverage in that sense.
Okay.
Yes, the total purchase price that we can get is around $230 million based on that 60% LTV.
But the 87 is not the initial equity, it's the total equity?
Yes.
Sure. As we've seen over the last 3 years, demand for spaces in this area have far exceeded the supply. So we're predicting that trend is going to continue. Speaking to leasing brokers, that's exactly what they're telling us. That's what we're hearing from lab science clients themselves. So yes, there is supply coming through, but honestly, it's just not enough to keep up with the demand.
Sure. So while we took a conservative approach to underwriting a new tenant coming in the office scenario, we think based upon the location of our asset, both in a market and in the cluster that we operate in, we think that long-term the gains from being in this area will be better off in the life science space than if we were to retain the asset and hold it and release it into office.
So we had our internal teams of architects and engineers look at the plans as well. They provided an assessment and a full report to us, looking at what tenants require, and they came back with a very high grade for it to say that it would be suitable for the conversion. So we believe that, yes, it doesn't serve every tenant that might be looking at the space, but it does, but for like 80% of those tenants, they would be satisfied with what we can provide.
And then just to adjust the last part about the cap rate, that's part of the reason why we underwrote to a 5% cap rate. We could probably sell it for 4.75 or maybe even lower than that, just based on the demand of the space, but we wanted to be conservative and keep that at 5.
So while they only have done ground up in the past, they have come to us and expressed their interest in both doing a renovation and their confidence in the ability based off of the asset the way it is now, currently with 50,000 square foot floor plates, 13-foot slab on slab heights. They felt it was a perfect asset for them to branch into the redevelopment field. And then the second part of your question was?
And then how do you feel about the structure they proposed?
The structure we had proposed, while there are some downside risks, a larger contribution to them, we felt that them taking the cost overruns aspect of the project also mitigated risk on our side. So we felt it was an even trade-off in the end that helped mitigate some of our greatest risks of construction cost overruns.
There's also the reputational risk. If this is their first project, they want to hit it out of the park. So we've accounted for that as well, and we think this partnership is going to be a good one for the long term.
Thank you very much.
Thank you so much for your time.